David Folkerts-Landau, once again, negative interest rates. What are the ramifications of this new bout of negative interest rates to market participants?
Good morning, Tom. Having 10 trillion of debt trading at negative rates is, we always forget it, but it's a historical anomaly. We have, in 2,000 years of history, not seen anything like it, or even though we tend to get used to it on a day-to-day basis. It is very bad news for Europe. In the sense that negative rates hurt the banking sector, the intermediation process. They project an aura of fear of something that we really don't know where to go from here on if things don't get better. So if you are a mid-sized German company looking to make capital investments, you say to yourself, negative interest rates, that looks very dangerous to me. And I'm not sure that the people in charge of making economic policy really kind of know what they're doing. So negative interest rates from that point of view have a very scary connotation.
The scary connotation is the x-axis, is the time continuum of where we are quarter after quarter, year after year of this agony. Where are we on the time continuum towards financial instability due to this experiment?
I'm not so much worried about financial instability as about this sort of grinding down towards the Japanese model. In some ways, when you compare the ECB and the Fed missed a turn. The Fed very aggressively started increasing rates 9 times last 2 years and is now not back to normal, but at least has enough ammunition and it looks very secure. If you look at the ECB missed a turn twice, and now we're stuck with minus 40 in the depo rate and 0 on the refi rate, and very little ammunition left other than, again, a concessionary TLTRO or a new QE. So it looks, if you look at the details, it looks very desperate in the sense that we don't really have a good set of tools to deal with any serious downturn in Europe. And that is what worries me more than just being down a little bit. But the lack of tools is dangerous.
So when do you expect a significant downturn? If you look at these recessionary risks, or we've had flashing signals, right, from bond markets across the world. We
have been among the more negative observers of European economic performance over the last couple of years. We were not surprised by the German numbers, and partly because we're reasonably close to our German clients and we see what they do in their investing behavior. And Italy came, of course. So the European numbers and the German numbers did not come as a surprise. I believe they will worsen. I would be surprised if Germany did not end up with a negative number for all of 2019, and the Eurozone as a whole between 0 and half a percentage point. So these are, it's not going to fall off the cliff, but it's a grinding down at a time when things should be looking good, given the kind of monetary expansion that we see. So it's more grind rather than a financial crisis issue.